All right, it's 11 o'clock, and this is your 20-minute Annuity Tuesdays. My name is Trent Zimmermann. I have a bachelor's with a background in economics, a master's in finance. I'm a chartered financial consultant and chartered life underwriter. Uh, this is brought to you by BGA Insurance. BGA Insurance is a wholesaler of life insurance, annuities, long-term care, and disability, working with independent agents across the country. Now, we've talked about liars before. We're going to talk about them again. This is going to be the redux. And we talked recently about working a system. And so let's just go back to basics for anyone who is new to this, or if you need a refresher, that we have the research. And I call out Morgan Stanley, um, but BlackRock confirms this. Dr. Falcon confirms this. Multiple Nobel laureates confirm this. And what we see is this trend that if you have an annuity in your portfolio, that's how Morgan Stanley defined it, that's how BlackRock defined it. Dr. Fowle, Nobel laureates, had some other caveats, and we're looking at more fine-tuned situations. But Morgan Stanley, over a 10-year period, looked at if you just had an annuity, doesn't have to be income, doesn't have to be fixed, it could be fixed index, it could be RILA, it could be VIA. But if you had an annuity, there's a 19% higher probability of sustaining income over a 30-year retirement. And in the minimum, you had 10% higher terminal wealth, 10% more when you died than you would have had without an annuity in the worst case scenario. And why is that? Well, let's go over the Dr. Fowl argument that people who have the best results in retirement have some sort of guaranteed income, time segmentation, equity growth, and risk wrapper. Now, I put income annuity because that's, as we've talked about, the most common way to guarantee income now that pensions have largely disappeared. Um, but if we look at this, annuities can fit in all four of these slots. Do I think they belong in all four of these slots? No. I think an income annuity works. Time segmentation, we've talked about that, and we're going to dive into that today. Uh, and the risk wrapper can be annuity, can be cash value IUL, it can be some bu other buffered accounts. There's a plethora of things that can be. And equity growth, although you can put in a fixed index annuity if they're highly conservative, maybe a RILA if they're less conservative, or a VA if they want to pick stocks and they just want the tax deferral. It has some other issues if you're not going to have the step up in basis, and it might halt your gains. So I don't think it's the best solution, but it can fit there. I think there's better ways that the annuities can fit in, and best would be slots one and two. We've talked about number four being cash value IUL, it can be a plethora of other things, but we're going to just focus on one, two. If an annuity can slot into any of these positions, if you have an annuity, it can slot into where you think it's going to fit best with your financial plan. But we've talked about working a system in these last few weeks and being prepared to work that system and follow up on a regular basis and have that scripting in hand. And so we want to be prudent planners. We want to be planning with purpose, not just hoping that retirement is going to work out. And so we're going to be sliding these where they belong. So we're going to be looking to provide a baseline of income. This is Blanchett's curve based on research she's done about how the less active you become, the less you're spending. And then at the end of life, as you have healthcare concerns, um, your spending is going to tick up. And so getting a baseline level of income at that high water mark is going to provide for you the longest period of time in your retirement and build up savings so that uh, you have a safety fund, and also you can prepare for those increased spending in later years. But we're seeing more and more that this is changing to this kind of chunking up of retirement spending because of inflation and because people are more active for longer. But still, we're providing that baseline level of income. And so now we might need to look at some more time segmentation so that we can live within this portfolio freedom effect. This is something we've touched on a lot. That this portfolio freedom effect is when you have those four pillars and you have a baseline uh, of income, of guaranteed income. You have your time segmentation, so you know the money you need for next year is sitting there. can't go anywhere. And in a down year, you have another pool of money to pull from. That you have this portfolio freedom effect where you can, instead of just being in a defensive position and allocating 40% to equities, you can allocate 80 to 100% in equities or real estate or international funds. You can get much more aggressive and have much higher compounding and much higher growth in your portfolio. You're not forced to sell in down markets, and you're going to slow your AUM depletion rate, especially for those of you who make money off of assets under management. You can make some money off of the commissions on these insurance products on the front end and move into growing that AUM at a faster rate and keeping it from depleting over time. And we're going to move away from the behavior alpha. So we're going to move away from people, what people typically do, and that's buy high and sell low. That's why individuals perform much worse than money managers on the aggregate. And why annuities, even though you're capping your gain at 9% on a fixed index annuity right now, tend to outperform the individual investor. Might not outperform the market, definitely won't outperform the market, and won't outperform most advisors, but will outperform the individual investor. But now, if we're looking at, we've got our income, that's all good. We're now looking at the time segmentation, and we still want to move away from this idea of the sequence of return is going to determine how much money we have in retirement. That is what we're trying to protect ourselves from. That's a much higher risk than we give credit for because bubbles are impossible to predict. Downturns are impossible to predict. And the market can stay irrational longer than you can stay rational. So even if you say, I think this is a bubble, the market can stay irrational for much longer than your pocketbook can stay rational and say, I'm going to stay out of this. And so we want to get rid of this situation. We're looking at in the Mr. Red and Mr. Green scenarios, the same sequence of return just flipped on each side. So that on Mr. Red, you have a bad sequence of return early on, and in Mr. Green, you have a good sequence of return early on. And you'll see, in the 2020 to 2024 scenario, you're running out of money at 79. Whereas you have 2.3 million in the Mr. Green scenario. And even in good situations of 98 to 2024, where you aren't running out of money in the end, you're still looking at almost 3 times more in the Mr. Green scenario. So we want to get out of this game, and we want to be looking at this research here from Jeremy Siegel, that the highest performing asset that we have access to is going to be stocks. It is also the most volatile asset in the short term. So how do we get out of that volatility in the short term and stay in that gain for the long term? And that's going to be having that guaranteed income and having that time segmentation. So how do we build that time segmentation? The traditional way is looking at bonds and treasuries, but bonds and treasuries can tank. We looked at in 2020 about 50% downturn. Now you can say, well, we're going to hold on to those for long term, and so this doesn't really apply to me. And what we that is true. But we look at this Fed rate and we look at the Treasury rate, and they're married, but uh, they're not closely married. They're more correlated, uh, and you'll see that there's a drag between that Treasury rate catching up. Um, and so we can look at something like a multi-year guaranteed annuity that more tracks the Treasury rate and outperforms your CD alternatives as a way to fit in there. And we can look at fixed index annuities that use the gain from those that treasury rate and debt that they're invested in to hedge and buy into option budgets that has outperformed the recent historical return of intermediate government bonds, long-term government bonds, corporate bonds, and 30-day treasury bills. We can outperform all those, but we learned our lesson in the ZIRP period, the zero interest rate period, where we were looking at near zero. and 10-year period around that where it was pretty low rates. And so we're going to look at the name of this. We're going to steal an idea from the bond market and build this bond ladder because we know we're going to get 5.56 to 6% right now in MYGA rates. Simple interest up to 7%. And we can beat out with that the historical performance of bonds, bills, and gold. Maybe not in the short term. Maybe in the short term, gold will skyrocket, but we can, in the long term, with these products, because of how they lock up your money and prevent liquidity and are tax deferred and built by these large organizations that have more buying power, are going to outperform these in the long term. And so we can steal this bond ladder idea to get rid of our risk of entering another zero interest rate period. And so at the front end of your retirement, you can buy a 1-year MYGA, 2-year MYGA, 3-year MYGA, 5-year MYGA, 7-year MYGA, and start preparing for when you need that money. And then every year on your annual review, buy up some more MYGAs and take some money out of your portfolio, de-risk it, get it so you can't lose and you're guaranteed to gain, and you have that money sitting there ready to go. And so that way, but actually, I'm sorry, not that way. Now we're looking at if we're doing this on a year-to-year basis, we're still concerned about our volatility drag. Because if we have to buy MYGAs every year, we would be forced to sell in a down year. And what does that do? If we had a down year where we were down 25% and you had to pull out a couple of years worth of money because you're going to only buy in the 2-year increments, 3, 5, 7. So now you got to pull out maybe 8%. So now we're looking at 33%. Maybe there's some management fees in there. We're looking at 34%. We need to make back up 54% to get that money back. As the market can do that, is it going to do that in a year? No. We haven't seen it do that in a year. Is it going to do that in 3, 4 years? Yeah, but now we've just put ourselves in a massive hole. And when we would have in a 25% down year, only had to make up 33, which is much more feasible to do. So we're looking at, I probably should have changed the order of these, but annual review, annual review, annual review. This needs to be part of your practice. And if you're doing this on a regular basis, maybe you won't be required to pull out in a down year. Because we can take a hint from Warren Buffett, it's insane to risk what you have for something you don't need. And we can take this cue from Nicholas Crown's Bulletproof Portfolio thesis that you build wealth in the market, you start to buffer with some bonds, and then when you need the money, you de-risk. And he talks about equity-linked FIAs. You can be at, I think that's better in the long term. In the shorter period, the MYGAs are going to outperform those. And so the opportunity here for you is the cream off the top strategy. Each annual review, instead of forcing yourself to pull money out and put it into a MYGA and to an FIA, you look at the portfolio your client has. Has it had gain? If so, pull out the projected amount of money you need and pad that with a little bit extra and put it into the MYGA ladder. And when you're at the front end of retirement, you're at 65. That's where you pad it the most, and you get the 1, 2, 3, 5, 7. And you just put some extra money in there to float. And now, if there's a bad sequence of returns, and you run through your float, you run through your pad, you still have that risk wrapper on the side to pull from before you ever have to touch that portfolio. So now your portfolio can keep running and gaining and doing what it does best. And the bonus for this is you lost harvest. Even if you have an up year, there's going to be some ETFs, some stocks that are down, and you can sell those so you're not having as big of a taxable event and putting them into these MYGAs, FIAs. And so now we can build out this ladder in a way that is not putting you in that volatility risk of having bad sequence of returns. It's guaranteeing the money is there, reducing the likelihood of all your money being up in a bad interest rate period because you're spreading it out. And if you have that float, let's say you had that 7 year product and you don't need it again, roll it over into another three. You have that five and you didn't need it at that point, you can roll it over into another five. And you can start maximizing the amount of gain you have on this instead of just rolling over a pool of 3 years and maybe 5 years from now you're shit out of luck that you have it's your interest rate period. Pardon the French. I was trying to think of a better term for that as we're going. And so we're building this four pillar retirement again, and you're going to work this system. And the first step of this is building their income floor. They've already done the growth all the way up to this point. So now we got to build the income floor. And then we got to do the time segmentation. Step four, the risk wrapper. Uh, you can use the annuities for that. You can use this ladder as well for that. You can have a larger pool there that sits in an FIA. That's a 7 year period, and you keep rolling that over in this ladder. And maybe you have tranches of that go into a 3 year MYGA as well and a 5 year product. But this can also be cash value IUL, and if you're planning earlier, you can do that. If your securities license, maybe put this into a RILA or a structured note, and then you have your equity growth there. And we can get back into this portfolio freedom effect because we've talked a lot about income. And we're looking more and more at not this being that Blanchard's curve, but it ticking up over time because people are staying active longer, inflation is running heavily, and people living longer are going to experience um, more health payments later on in life. So this time segmentation is that next step you need to take in the system we're working. And if you aren't having these conversations with the clients, remember that somebody else will. And we are, and there is a good chance. Sorry, I shouldn't say that yet because I got a different slide first. The opportunity is there. This is going to become more and more important over the next couple of years as we're going through peak 65. 24 to 27 is a huge milestone shift in the US where there's going to be an explosion of near retirees. And so the opportunity is immense coming into this, that you are going to be able to do some prudent planning with purpose, the three Ps, and build these four pillars for your clients. And you need to work on those four pillars of having the income annuity and building those ladders. Don't put your clients at risk of having all their money come up in a near zero interest rate period if we have a rate drop. And the great thing is, you might not need to pull any money out of their portfolio. You might have the golden ticket of a product that they don't need to buy, but they need because they already have that money sitting there. We're looking at record-breaking renewals. 60 billion in MYGAs coming up for renewal this year alone. 400 billion in annuities sitting outside of surrender. These people already have the money. So maybe you don't even need to do the time segmentation from the portfolio. You can look at what they already have and say, look, I think you're at a lot of risk of these products falling apart outside of surrender. And if you get one new product of entering into a near zero interest rate period when it's up for renewal, or just not having the liquidity you need, I can build a ladder for you so that you have more liquidity, less risk of bad renewal rates, and get out of a product that no longer has guarantees because it's out of surrender. And once again, we're looking at Al Aggressive and Carl Conservative, and this working for both. This is going to help Al Aggressive stay in the market for longer, and it's going to help Carl Conservative get into the market because he has less at risk. So it takes only a second to be brave. We've talked about this. Scripts are going to lower the bar. Process is going to lower the bar. Start asking your clients these questions. Do you have any CDs or annuities you want me to review? What's the amount of income you cannot live without? Do you have any guaranteed income assets? How much of your portfolio can I afford to lose? If I can guarantee you X% return over Y years, I know. Great. These are the last two are a little bit heavy hitters that might not feel natural, but we do have, if you've started asking these questions, we do have a fact finder. And if you want it, send me an email. We'll get it to you. And if they say yes to these questions or they want to hear more, go through the fact finder. You do not need to be an expert yet. We can be your back office, prepare some recommendations for you, and we can sit in on those meetings with you to help you explain those. And when you're doing this with your clients, ask early and ask often. Referrals are the bedrock of every good advisor. So that's all I got for you. That's your 20 minutes. I nailed it this week exactly on 20. It's great. So I'm going to take some questions. I see we already have some popping up. I'll hang out for a little bit longer. Um, yeah, so liquidity question. So let's go back to this. Um, how does this actually provide more liquidity? Great question. So if let's say you have two scenarios, one where somebody just bought the best accumulation annuity that money could buy right now. Um, and so let's say the best one right now is going to give you about 10.25% on an FIA. It's going to be a 7-year product. So you only have 10% free withdrawals in there starting in year two. And that's going to last for 7 years when then you have it all available. And then you're gonna have to roll over into one more product after that. So what if in any year you have an emergency that requires you to pull out 12%? You're going to pay a fee on that extra 2%, or you're going to have to pull it out, excuse me, from a different source. So what if you had a 1-year MYGA, a 3-year MYGA, a 5-year MYGA, and a 7-year MYGA, or sorry, 7-year fixed index annuity? Um, Now, every 2 years, you're going to have a tranche come up. And if every year you're also saying to that client, okay, let's take some more money and let's de-risk it because you're going to need this in a year or 2 years, 3 years, then we can move into a point where every year you're going to have a tranche of money come up and be available. So now not only do you have the 10% free withdrawals on all the rest of your pool of money, you have a pool of money that's readily available to pull from. Your 1 year is up. Your 3 year is now up. Your 5 year is now up. And so you'll have an increasing amount of liquidity coming up. Now you can relock that up and you can put it in a new policy and roll it over. And that's going to continue to reduce your risk of entering into a new um, bad interest rate environment. Because let's say that 1 year's up and you take some out for your retirement and you don't need all of it. You can put it into another 1 year, you can put another 3 year. All those are available to you, and you can keep rolling these over. And so what we would get to in this is a place in your retirement where every year you have a tranche coming up of money, and then you have the 10% free withdrawal from everything else in case of emergency. So that's the liquidity piece. Does that make sense? If you can give me a thumbs up or something. Um, can we have the PowerPoint for this presentation? Yes. And the scripts? Yes. How can we present combos to clients? I think you mean combos of, um, I'm assuming you mean combos of annuities. So let me take a swing at this and you can follow up and ask a question. Um, oh, FIA MYGA combo. So fixed index combo with the MYGA. Um, a fixed index annuity needs time because we know in 10 years, there's probably going to be 2 to 3 down years, just on average. Um, but we saw let's go back to these. Where is it? I need my Mr. There it is. So we saw in here, you can have a bad 3 year period easily. And then the next 2 years, it's keeping up. And so if we get into a 7-year FIA where the rates are really good, 10-year isn't as good. But maybe you want that to hedge for a longer period of time. So you get a 7 and a 10-year MYGA that can use this time to be able to make that gain and have the benefit of having a 9 to 10.5% cap. So they can have a few down year or 0 years because you're going to make 10 on another year. When you look at 5 years, if you miss 1 year, you're pretty close to the MYGA rate. If you miss 2 years, you're below the MYGA rate because you're also going to have less on that cap. You might be getting 8%. And uh, uh, if you miss 3 years, you're well below it. Now, there are some products out there that, there's one in particular that will guarantee you 8.5% in year one. So if you think the market's going to go down next year, you can get that. And then you are fine with the indexing for the next 2 to 4 years, depending if you want the 3 to 5 year FIA. Great. That's what the client wants. But if you miss a year, you're close to MYGA rate. If you miss 2 year, you're under the MYGA rate. That's why I think it's just the 3 to 5, put it at a MYGA. The comp is going to be almost the same. It's going to be a little bit higher in the FIA, but use them where they work best. Get the 5 and under, get a MYGA. 5 and above, get an FIA. And maybe that 5 year, if you disagree with me and you want an FIA, do it. Do it. I mean, I'm not, I'm no genius. These are all my opinions. I back it up with a bunch of math and statistics, but you're going to have your own opinions as well and your background. Yeah. We got a situation question. Got a lot of questions today. This is great. See situation question, but I don't see the question yet. I assume you guys are typing. Oop, should put that on that one. If client has 150 now and 100K in a month or two, how to position? He's 70. Okay. Good question. I mean, personally, I think that's best case scenario for a ladder. It's kind of naturally doing it for you. You put some money into a couple different products. Um, but that being said, I like the ladder. It reduces a lot of risk. I know for clients' sake, they don't want a lot of moving pieces. So here comes the issue of if they want one throat to choke in terms of a finance company, how do you handle that? So if you have 150 now and you're gonna have 100 later, I think the best option for that is start telling them the story of the ladder and start building that. Maybe put 50,000 into a MYGA and then 100,000 into a MYGA and then that next 100,000 they're gonna get goes into an FIA. Just an idea. Um, but if they say I want one throat to choke, and I'm fine being locked up for a little bit longer, then put them into a multi-premium annuity. You can get that with an FIA. Some will just allow it in the first year. Some will allow it in the life of the policy. Um, those are a great option that kind of look like a retirement account. They're 70, so I think that's less of a worry. Um, but yeah, I would start building that ladder. Um, And if they want to put it in MYGAs, if they want guaranteed rates, you are going to have to build a ladder or wait. Because putting money into a MYGA later is going to mean they're going to go from a guaranteed rate for the entire term of the policy to that second bunch of money that gets put into an annual renewable term. So that's going to be a lower amount that they're guaranteed, and it's going to change from year to year. So they don't want to do that. 357 is what I like. That's where the best banding is um for your rates when you're looking at that. Not a lot of companies have ones and twos and fours and sixes. A couple do. But the banding just tends to be better on 357 because that's also when most getting to in the weeds, but most of the debt obligations are up. If you're looking at their debt obligations, they're looking at 357. So it's easy for them to build a product around 357. It's a little bit harder to build 123 or 1246. Great questions today. What makes the longer term MYGA so attractive is by looking at the historical return best performing FIAs. So unless I have a guaranteed income requirement scenario, 7 or 1, even 10, 6% guaranteed each year. Pretty hard to say no to since again the historical rate. Good question. So the question there is MYGAs right now being so high, is it even worth getting into a fixed index annuity if you don't have an income requirement? It's pretty hard to say no to guaranteeing 6% year over year, especially when the history of the stock market over the long term has returned 6.9 uh, for the average investor, um, and bonds are going to be much lower than that. Why would you say no to six? Let me find that slide for you. Um, so the historical performance of an FIA as a market whole is going to be 6.88. So it's going to be slightly higher. Now, we have a lot of bad FIAs out there right now, owned by private equity companies in volatility controlled indexes with bonuses and fees and just BS. I don't like them. If I can get a good, clean FIA um, that has published their renewal rates, has a great alert score showing that they have met their promises or exceeded their promises, and are highly liquid and can prove that they can continue to maintain that cap, um, and you're bullish on the market, why not have something that can perform higher? On the average, it's going to perform maybe around the same, but it has potential to perform higher. If the client's bullish on the market, why not? I think where it becomes more enticing is when you have a good participation rate, because the participation rates on a gangbusters year where you're up 30% in the market and you're making 60% of that, and so now you're getting 18% instead of 9, and then everything's going to compound off of that. That's a really enticing story. And so there's a couple products out there that you can blend a cap and a participation rate so you can hedge against some years that are going to be under, let's say, 18, so that you're going to do worse than the cap. Uh, and those historically have done pretty well. They've beaten the historical performance of the of FIAs. That being all said, there's a lot of people in this peak 65 period who lived through really low um, interest rate periods that they got really low returns on their annuities. They might have come up and gotten a volatility control product that has been pretty bad, and now they're concerned about it. And why fight them on that? Just give them what they want, get them a good product, get them a good guarantee. So I think the answer is kind of a little more nuanced than why would you ever take a MYGA, or why would you ever take a FIA when MYGA rates are so good? I think it's more just about the client, their tolerance, and your selection of the FIA. If you can get a good accumulation FIA from a good company, that's good opportunity to grow, and worst case scenario, it's probably going to perform around a MYGA. Is that the upside that the client wants to take? You um, I think that can be an enticing story. Um, But it's up to the client. It's up to you. Do you feel comfortable positioning that? Do you feel comfortable explaining that to the client? Does the client understand that? And are they happy with that upside potential? Will there be refreshments after for the attendees? Come to the office. I'll take you out. Take you out for coffee. Or if you come at the end of the day, there's breweries nearby as well. You guys have stuck around for a good long time. Thank you all. This has been great. I've never had such a good question section. All right. If there's nothing else, I mean, you can throw more in, but I think 15 minutes over, we've answered a lot of good questions. Can't imagine you guys would have much more, but you've already surprised me. So if there's nothing else, I'm ending this thing. And you have my contact information. I'll go back to that. Bingo, bango. Snap a picture of it. Call me, text me, email me. We'll talk more if you have any more questions. Thank you all.